Hi, everyone. This is Terrell Robertson, the owner of Robertson Investment Group. Today, we're going to be talking about the direct banking method, a root asset inside your portfolio. What is the direct banking method? The direct banking method concept has been used by banks, businesses, and wealthy persons for well over 100 years. This concept allows for you to operate as your own personal bank and has also been known as the infinite banking concept, IBC for short. Life insurance, retirement planning, LIRP, bank-owned life insurance, BOLI, which we'll talk about further inside the presentation, and bank on yourself. The direct banking method is a financial concept that utilizes dividend-paying whole life insurance from mutual life insurance companies. So we are talking about life insurance. That is the vehicle that makes the direct banking method work. So in particular, it's with mutual life insurance companies that pay dividends on the policies. 10 benefits of the direct banking method. Number 1, uninterrupted compounding interest and dividends. Number 2, take advantage of the investment opportunities without losing the benefits of above. And number 3, ability to shield your money from the stock market and all its losses. And number 4, lifetime of tax-free money based upon today's tax code. And number 5, predictable growth in addition to all other investments. Number 6, recapture all current and future interest on debt. Number 7, perpetuate multi-generational wealth. And number 8, enjoy one of the most secure ways to utilize your money. And number 9, full access to your money with no hidden fees or penalties. And number 10, outpace inflation and deflation. Wealthy and famous persons that use dividend-paying whole life policies as a secret weapon. First, we're going to talk about Walt Disney. When the banks will not grant Walt Disney the capital to fund Disneyland, he used the cash value and his dividend-paying whole life policy to seed the creation of Disneyland. The second person we're going to talk about is J.C. Penney's. J.C. Penney used the cash value of his dividend-paying life insurance to help his company survive after the 1929 stock market crash and ensuing Great Depression. During this time frame, Walt Disney and J.C. Penney's had some of their safe liquid money inside dividend-paying whole life insurance. And that was for most Americans during this time frame as well, too, because inside the stock market, it was too risky. They deemed it too risky, and they seemed it was for more of persons that wanted to take on a higher risk, and they had more money to risk losing. So when you think about your investments inside of the stock market, an example, your 401k IRA, how much of that is guaranteed, and what will you know your exact account value, the worth of it, in worst case scenario, regardless of market conditions and real estate markets and stock markets, how that would fare for your retirement portfolio. Well, they like dividend-paying whole life insurance because they knew that their money was safe and guaranteed based upon the 10 points that we talked about earlier. Ray Kroc filed the McDonald's brothers to use the cash value from 2 of his dividend-paying whole life policies to get McDonald's off the ground and running. Families like the Rockefellers, Carnegies, and Rothschilds have used dividend-paying whole life policies to build and grow and protect wealth for generations. Bank-owned life insurance, also known as BOLI. Banks hold their Tier 1 capital inside life insurance. When the customers deposit funds, they take a portion of the deposits to purchase more life insurance on our key executives. Your bank has billions of dollars inside life insurance. Why does the bank own that much life insurance? And if it's good enough for the bank, why isn't it good enough for your portfolio? So right here, what we have is Bank of America's FDIC document. And you can find this document on FDIC.gov. And you look at line items 41 through 44, and these numbers are in representations of thousands. So this number right here is $21.9 billion. And this is as of December 31st, 2017. And this is the previous year, December 31st, 2016, and they have $21.4 billion inside life insurance. And the reason why is because of those 10 benefits that I talked to you about before. It offers them liquidity. It gives preferential tax treatment, and so they like life insurance a lot, so much that they're willing to put billions of dollars into it. Wells Fargo is another bank that does this as well too. Look at their FDIC document. Look at line items 41 through 44. Once again, you can find this document on FDIC.gov, the assets and liability sheet of the particular bank that you're looking for to see how much life insurance that they do hold. And you see it listed here is this asset. They consider asset not an expense, but an asset because it holds cash value, whole life that is. And they have $18.4 billion worth of life insurance. In the previous year, 2016, have $18.2 billion worth of life insurance. So they purchased almost another $200 million worth of life insurance. This is a case analysis of a client of Robertson Investment Group. We didn't want to use his real life name. We wanted to change his name so we could protect the identity of this client. So we just call him Kevin, right? So Kevin is 45-year-old male. He's a general family physician. His wife is 40 years old, a non-working spouse. They have an annual income of $190,000. After paying taxes and their benefits, they have about $10,456 per month that they have available to spend. And they have 2 children, and their concerns that brought them to the direct banking method is they want to provide a loss of income in case of death. They also want to ensure college funds for the kids, having a secure retirement by age 65, and liquidity for an emergency fund, and eliminating debt. So Kevin's monthly liabilities, they have a mortgage. They've been in their house for 10 years. They see it as their forever home for the most part, and they're spending $2,400 a month, and that includes the mortgage, the insurance, and the taxes. And they have a remaining balance of $391,000. Their car loans and insurance, they spend about $1,500 a month. Their credit cards, they have a remaining balance of $16,000, and they spend about $800 a month. And their utilities, it's about $800 a month, and their miscellaneous expenses that they have is $350 to $500 a week. So it's total liability of $6,900 to $7,500 per month. The remaining disposable income that they have after paying all their bills is roughly about $3,500 to $2,900 a month. So what we did was we redirected where they were saving that money at, and we put it inside a direct banking method policy, and roughly about $2,500 of that on a monthly basis. So what we're going to show here is with a traditional whole life policy, and this is what most financial pundits say is a bad investment, and I want to show you if Kevin was to take that same $2,500 per month, which is $30,000 a year, and put it inside a traditional whole life policy without having it specially designed, how it would perform, and how the most financial pundits that say invest term, buy term and invest the difference, the reason why behind that logic and reasoning. So before I go deeper into this, I want to explain each column here so you have a little bit more clarity on what it is that I'm talking about. So this is the end of the year. This is the age. This is the contract premium. So this is how much he is going to put in each year into the contract. This is the guaranteed cash value that the life insurance company is on the hook for, to make sure that they absolutely have to make sure that that money is readily available to you, and you can access funds with whole life policies. Typically, they'll be deposited into your account within 2 to 3 business days. And this is the guaranteed death benefit, and this is the annual dividend. that mutual life insurance companies pay out. The companies that we utilize, they've been paying dividends for well over 100 years consistently. They haven't missed a dividend. It's not guaranteed, but it is based upon the profits of the life insurance company. And every single year for well over 100 years, the life insurance company has been very, very profitable. And some has paid dividends as far as back to the Civil War. This column right here is the premium outlay. This is not only how much money that you're putting into the policy, but this is also what illustrates how much money will be taken out of the policy as well too. This is accumulated paid up additions right here. So this is additional insurance that's being bought by the reinvestment of the annual dividends into the paid up additions rider. This is the paid up added cash value. So each year right here that a dividend is declared, you'll see that this represents the cumulative amount of dividends that's been added to the policy. This column right here, the total cash value, this includes the guaranteed cash value that has the 4% interest minus the applicable life insurance fees. And then in addition to that, the annual dividend that was declared by the life insurance company. And this is the total death benefit that starts off with initial death benefit of $1.4 million. And you see, as the policy grows and the cash value grows, so does the death benefit. So this is how you would have access to your cash value and plus the death benefit, because the death benefit grows in correlation with the cash value. So your cash value, if you were to pass away, is inside the total death benefit as well. So looking here, you see here in year one, if Kevin was to put $30,000 into this policy, he doesn't have any cash value. And that's not very, very attractive. And so in that case, the financial planners that say that this is a bad investment, they are so correct, because myself personally, I wouldn't put $30,000 away like this if I need it for a liquid emergency purposes, or the opportunity to have money stashed away just in case when an investment opportunity presents itself that I can take advantage of it. And even here at year 10, you see that he's put $300,000 into the policy, and the guaranteed cash value is only $200,000. I still want more guarantees than that, and this policy can be structured a lot more efficient than the way that it's set up currently right now. And so we even were to include the annual dividends that the life insurance company would pay out over this particular point of time, you see that it's only $262,000. So it's roughly $38,000 that you're still inside the hole that you put $300,000 inside 10 years and still have a $1.6 million death benefit. Not very attractive. If I go here to year 20, I put $600,000 over a 20-year period, and I still have $491,000 of guaranteed cash, and I still that's still not very attractive, in my opinion. But if we were to include the dividends and the dividends were to compound each year, well, what you would see is that you have $744,000 readily available to you. So the $600,000 that you put inside there, including the dividends, you do get roughly about a 25% return, $144,000 return on investment on your money, and it is safe, it is liquid, and you would still have a $1.9 million death benefit. Going to the average life expectancy currently right now, which is around about age 85 for men, you see that guaranteed cash value is $746,000. And if we go to total cash value and include the dividends, you see $1.4 million is the total cash value, including dividends, and the death benefit is at $1.7 million there. So the longer you do keep the contract, the fees get less and less with whole life, and so therefore it gets more and more efficient because as you're living longer and your cash value is building, the risk on the life insurance company is less and less and less. So that's why the contract is more and more efficient long term. But this could be a better contract the way that it could be structured. Even at age 21, when the policy matures, if you were or Kevin was to live that long, he would get a $2.7 million death benefit and still have $2.7 million cash value. So looking at a direct banking method policy, what you would see here is the same thing. This is the contract premium, the guaranteed cash value, including 4%, minus applicable life insurance fees, the death benefit, the annual dividend that these companies have been paying for well over 100 years, the premium outlay of not only how much money that you put into the contract, but also how much money that you're taking out, and the paid up additions of additional insurance, and the paid up cash value, and total cash value to include the guaranteed cash value plus the annual dividends declared, and the total death benefit, and the growth in correlation with the cash value as well too. So looking at year one, how this policy is structured, we have lowered the death benefit to lessen the applicable fees. In addition to that, we've added term riders and paid up addition riders to allow for that same $30,000 to give you early access to an emergency fund if need be, so that way your $30,000 is not locked up, it's available to you, and you still have insured that money with a death benefit as well too. So $23,000 is what's available within the first year guaranteed, and you see that there is a dividend declared that year, and so the guaranteed cash value for the first year is $23,743,000, and you still have an $830,000 death benefit. If we were to go comparing apples to apples with the previous traditional whole life policy, just not being structured any differently, but the direct banking method policy has been structured how Robertson Investment Group would structure it. You see right here that the policy is you put $300,000 into it, and you got guaranteed $300,000 that's available to you in liquid cash in case you were to need access to it. And so this right here, dollar for dollar, you're guaranteed, and you still have a $1.4 million death benefit. And if you were to come over here and include the dividends, you see that there's $324,000 of total cash value, including the dividends. So you made $24,000 inside 10 years on that money, and it's safe, it's liquid, you didn't have to pay any taxes on it, and you can utilize it for whatever you so choose, and you still have a $1.5 million death benefit. And we go down here to year 20, and that you put $600,000 over a 20-year period up to age of retirement. You'll see that this guaranteed cash value is $700,000. So you have $100,000 that you made, worst case scenario, that's going to be guaranteed on this contract. A huge difference than what a traditional whole life policy would offer you if you were to implement a direct banking method policy. If you were to go all the way over to the total cash value here, you would see that it's $813,000 included with the dividends, and so that $600,000 investment, including dividends, is $213,000 profit. So a little over 33% return on your investment, and it's safe, it's liquid, anything that you want to utilize it for, and you still have a $2.1 million death benefit as well. Going to the average life expectancy inside a direct banking method policy, you'll see that worst case scenario here, that $600,000 investment has grown to $1 million, has a $1.3 million death benefit, and including dividends, it's grown to 1.5. So that's roughly a little over $900,000 that you've got a return on investment on your monies by implementing this strategy and having the contract structured like this to make it more efficient and make more money on that dollar. And you have a $1.9 million death benefit. And if you were to go to when the contract is to mature, you'll see that the total death benefit has grown to $3 million, and you have $3 million cash value as well. So what we're going to talk about is how you would access the money and how it accomplish Kevin's goals, right? So the first year he put $30,000 in. He has that $23,743 dollar cash value there. And the second year he's taking $16,000 out of the policy, and he's going to pay off that credit card debt. So he's no longer got credit card debt, and he's going to continue to receive the interest off that money instead of him paying that interest to a finance company and never getting that money back. And so with that, him doing that, he still has $32,000 cash value. He then goes inside year 9, and he takes a loan amount of $225,000 to pay off his house. So now at this point, he's been in his home for 19 years. If he would continue to pay the mortgage premium, he would still have 11 years to pay. But because he put the money inside this direct banking method policy, he's able to pay the home off in year 19, 11 years earlier than what he was scheduled to do. And what he's doing here is he's going to repay it back, that same $2,400 a month that he was paying for a mortgage payment, and he's going to put it back into the policy. And he's going to recollect on all that loan interest, because when he pays that interest in a form of a loan, which is about 5%, the life insurance company, when it profits from that, it shares back to its policyholders in the form of an annual dividend. So it's pretty much, if you're paying the loan interest, you're pretty much paying yourself back, is the concept. And so in year 16, he's going to send his first kid $80,000 to help offset college expenses, and he still has $429,000 available to him. And 2 years later, the second kid is going to be going off to college, and he's going to take another $80,000 to offset their college education as well too, and it still has $467,000 total cash value. And so you see, he still has a loan balance here in the 20th year, and the policy is completely paid up inside the 20th year. But to take care of that loan balance, so the interest doesn't continue to accumulate, we're going to take a withdrawal amount out of the cash value to pay that loan balance off, and he still has $581,000. So if we recap real quick, you see that $16,000 to pay off credit card debt, $225,000 to pay off the house, 11 years ahead of schedule, and an $80,000 and another $80,000, $160,000 together to offset college expenses for their 2 children, and $31,000 to pay off the loan interest that's built up inside the policy. So together, that's $432,000 worth of cash value that's been utilized to benefit Kevin and his family. And so here, inside year, when he's age 70 years old, he's going to start taking a $30,000 a year passive tax-free income inside retirement, a true $30,000 versus an example. You have a 401k or a traditional IRA. The money that you access, if you were to take $30,000, you would not get $30,000 deposited into your account because taxes have to be withheld out of that $30,000 that you are withdrawing from that retirement account. So if we go here, you will see that he's taking the passive income all the way to year 90. So 20 years, he's taken another $600,000 out of the policy. That's completely tax free, and up to his cost basis here inside age 82. He's taken that money, and he's exceeded his cost basis at that point. So he then switches over to form of a loan to start taking income, so that way he doesn't have to pay taxes on the excess total cash value that he has here. And so you see here at age 90, he still has $287,000 available cash value to him, and he still would leave his family, his wife, or his children, $309,000 of total death benefit. So to recap one more time, he's had $431,000 that he's benefited from, and his family's benefited from, for paying off credit card debt, paying off his house early, and sending his kids to college. Now he has another $600,000 that he has benefited from inside retirement by not having to pay any taxes on that money, and it's going to lower his tax position because he didn't have to pay any taxes on it. So that's really, really powerful. It's very, very beneficial for a client. And if we were to go when this policy would mature, you see here at age always age 110, that same $1,032,000 that he's benefited from, he still would have $24,000 available cash value that you have access to, and still leave a $77,000 death benefit to his beneficiaries as well too. So Kevin's direct banking method case highlights. Kevin contributes $600,000 over 20 years to his direct banking method plan. He eliminated $16,000 of credit card debt. House was paid off with $225,000 in his ninth year, 11 years ahead of schedule. Helps offset college expenses by providing $80,000 to the first kid in his 15th year, and helps offset college expenses by providing another $80,000 to the second kid in the 18th year. At age 70, he's taken a tax-free passive income for 20 years, totaling another $600,000. So total, he's benefited well over $1 million, and he's still going to leave a death benefit to his spouse or to his heirs, and he's still going to have some access to cash value. So this is a very, very powerful concept that can be added to your retirement portfolio, and you can really, really benefit from it. As I mentioned before, those 10 benefits that you have: the liquidity, the ability to earn interest in 2 places at once. So that's very, very attractive. What is needed to complete an analysis? We charge at Robertson Investment Group, charge a fee of $299 for policy design and advisory services. We'll schedule a complimentary health examination, and we'll complete a financial needs analysis of income and assets, like we did inside Kevin's example, and we'll complete a life insurance application for our applied carriers, and we'll just need to know a scheduled start date to fund the plan to implement the direct banking method. So if you have any more questions, please feel free to respond to the email that you received this information from, or give us a call at 803-873-9017 to talk to one of our qualified advisors, get more information about the direct banking method, and we look forward to hearing from you, and we can't wait to start your plan. Have a great day.